Hit record. There we go. Okay, super. Well, welcome. Thanks for showing up this evening, those of you who could make it, and for those of you watching the recording. My name is Laurie Kozar. I'm a financial and energy coaching specialist at Capstone Community Action. I work for a program that is called GreenSavingSmart, and we help folks with financial and energy efficiency opportunities. I've been doing this for a little over a year and a half. And if you'd asked me a couple of years ago, would I become a financial coach? My answer would have been no. It was not really something I had aspired to, but a couple of things brought me to it. And one of them was managing my own money and setting some goals for myself. And the other was energy efficiency and making some changes there. So let's get on with our show here. As I said, I work for Capstone Community Action. It's part of the VCAP, or Vermont Community Action Partnership, and that consists of 5 community action agencies throughout the state. And the GreenSavingSmart program helps folks to review their finances and make a budget. A lot of people have challenges with budgeting. Often finances and budgeting is not something that's taught in school. So this is a great opportunity to pick up some skills. We help folks plan, and whether that is for financial goals or energy efficiency goals, making their home more comfortable, or perhaps having a more energy efficient vehicle, we help folks to sort of look at those opportunities, figure out how to budget for them, and achieve them. So a lot of that is navigating energy and savings opportunities, and just basically helping folks to save money to not only meet their living expenses, but to meet other goals, long-term goals and short-term goals. So one of the first questions that I usually ask the clients that I work with, and beyond doing these workshops publicly with partners like the Kellogg-Hubbard Library, I also meet with clients one-on-one, and I do that mostly remotely. One of the first questions that I ask clients is if they have a savings account or an emergency fund. Having a savings account is basically, it's really crucial for your financial stability, and it provides a cushion for unexpected expenses. And especially an emergency fund is really, it's a safety net during challenging times. And those times might be a job loss, economic downturns, even events like we recently had with the flooding. And, your savings account can get reduced pretty quickly, but if you have an emergency fund in addition to your savings account, it kind of helps you out to meet your monthly bills, and it really can help you plan for the future. So as I said, it's, short-term goals, mid-term goals, long-term goals, and an emergency fund is really critical for having some financial stability and removing stress from your life. And it's really possible for individuals to build wealth over time if you just sort of stick to a couple basic things, the first of which is consistency. It's more unusual for people to build wealth all at once or have a big windfall or win the lottery. Those might be really nice opportunities that might be out there, but unless you have an old Aunt Tilly around who, you're her favorite niece or nephew, and she's going to leave you a chunk of change. It's important to work on your savings yourself. And so what's an emergency fund exactly, and how is it different from a regular savings account? So let's start by really defining what a savings account is. So savings accounts are really, it's just a bank account that's designed for depositing and storing money. And most savings accounts pay you interest. And so banks and credit unions offer a secure place to hold funds, besides, stuffing it under your mattress or keeping it in a jar. it provides you not only a secure place to store your money, but you also get paid a small percentage for that money to be sitting in a bank account. And there are some key features. As I said, the first is safety. Not only is it a safe place to store money, but generally, savings accounts are insured by the government. You often see signs that say FDIC insured at the bank. It's just important to know that the FDIC insurance only covers up to $250,000 per account. But still, that's nice insurance to know that your money sitting in a bank earning interest is also basically insured by the federal government. Savings accounts also allow your money to grow over time, and that's through the accrual of interest. And interest, I think, is the percentage of money that a bank's willing to pay you to have your money deposited with them. Savings accounts also offer something different than other types of accounts, investment accounts, and that is liquidity. You can easily access your money. You can make withdrawals or transfers whenever you need to. And that's a big plus if you need to make a purchase and you need, especially with emergency funds. But the bottom line is utilizing a savings account, you could really separate your savings from your everyday spending, and you can earn interest on those deposits and work towards achieving your financial goals in a secure and systematic way. Oops, so sorry, I popped around here. So I hope you guys are all seeing this screen okay. I'm so sorry, I have a little technical jaunt going on here. So as I said, it also offers you some financial freedom and reduces stress, enhances your peace of mind, and helps you achieve financial goals. So how do you start? Let's talk about the how of creating a savings account. So one of the first things that you really want to do is assess your financial situation. So by assess your financial situation, I mean, you review your income. You look at the money coming in and you track your expenses, your money going out, your debt, your cost for living. And you can really, basically just do a pen and paper kind of accounting of these things. Some of the other things that you really want to do in assessing your financial situation is to really sort of gain a comprehensive understanding of your financial position. Are you doing as well as you would like to be doing? Are you meeting your daily expenses? That sort of knowledge, that sort of overview or comprehensive understanding of where you are is very empowering. It can really help you make informed decisions. It can also help you set realistic goals. It could help you develop effective strategies to enhance your financial well-being. And so, it's fairly simple steps. So you review your income, you look at, your hourly, weekly, or monthly income from work. Some people have a regular job and other people are self-employed. Some people even have a side hustle in addition to a regular job. But income can also include things like the interest on your savings. Savings accounts, some savings accounts pay more interest than others. There are also certificates of deposits, also known as CDs, money market accounts, and other types of investments that allow for passive income. And that might be things like rental properties. And then another way to look at your income is to consider if it's regular income or irregular income. In other words, do you get paid the same amount every month or biweekly? Is your income going up and down depending on the number of hours you're working or the type of work you're doing, or how many jobs you're working? So basically determining how stable your income is. And then one thing that in reviewing your income, you can also look at is to identify if there are any areas for potential growth for your income. That might be, again, a side hustle or pursuing a better paying job. The other thing that you want to look at in assessing your financial situation is tracking your expenses. So evaluating those monthly expenses that really can help you understand where your money's going. And you can categorize those into what are called fixed costs. And those are like rent or your mortgage, your cell phone service, your, costs that are pretty much stable month to month. And then variable costs, those are groceries or entertainment. And then you could also look at, in tracking your expenses, you can really start to see where your money is going. And you also can identify if there are areas where you'd really like to reduce your expenses and find more cost-effective alternatives. So once you've sort of taken those first two steps of reviewing income and tracking your expenses, then you can really start to look at your debt and liabilities. And analyzing can sound like a very intimidating word, but basically what I mean by that is really just determine the types of debt that you have and the amounts that you owe on those. So if you're carrying credit card balances, what's the percentage you're paying on those credit cards to carry that balance? If you're carrying student loans and you have to pay those back, what is your debt there? Other types of debt are car leases or a car loan, a home, or a home mortgage, are other types of debt. And so really looking at those debts, what are also called liabilities, can really help you understand where your money is going. If you're paying a high percentage on a credit card and you're carrying debt there may be a better way for you to manage that. And for some people, they have multiple credit cards and they're carrying balances on a number of them, or they'll roll their debt along through credit cards, but they really never quite make a good enough dent in it to reduce what they pay over time. And some people end up just paying a huge amount in interest regularly. So really analyzing that debt and what you're paying to carry that debt really can help you get a handle on things. And the other piece with assessing, or analyzing debt and liabilities is it really could get you to look closely at the repayment terms, if there are fees, and not just the interest rate, but if you're paying fees, for late payments, or you're paying a fee to have a credit card, some of those things you can really chisel away at and save a little bit of money and put that money in your savings account. Also looking at debt, you could consider opportunities for refinancing that debt or consolidating it, and always, looking at the terms and conditions. A lot of financial coaches will suggest that, that you calculate your debt to income ratio to understand how much burden you're carrying, how much debt burden you're carrying compared to your income. Investopedia is a good site to learn a little bit more about that debt to income ratio and how that impacts your ability to borrow money and finance other needs in your life. Basically, a 43% debt to income ratio is the limit that lenders will even consider in making a mortgage to you. So knowing where you stand, if that's one of your long-term goals, it's good to get a handle on that. And then lastly, evaluating your savings and investments, reviewing your existing savings accounts, your retirement funds. If you have a 401k at work, looking at that, how much funding you have in there. If there's a match, your work offers you a match, really taking advantage of those. If you have a, 3% of your salary, for example, you can put into a 401k with a match from your employer. That's 6% of your salary going into a 401k, and that can be substantial over time. Might not feel like a lot week to week, but it adds up quickly. And even if it's, if they limit it to say 3%, and then anything above it, they only match it at 0.5%. If for every dollar somebody offered you 50 cents more for you to hang on to that dollar, that's not a bad opportunity. So even if it's a portion of your match, it's sometimes worth looking at. Anyway, I guess my other points that I'd really like to make are that, by looking and evaluating your savings and investments, you could really calculate, the rate at which you're saving, how much you want to save, what you've been able to tuck away over time, or what you'd like to tuck away over time if you have some long-term goals. And it also gives you an opportunity if your savings and investments are not performing well, and market conditions change, like currently interest rates are very high on certain savings tools. You might want to roll some money into different savings opportunities. So moving on, I like to think about a budget not just as a way for you to cut your expenses, for any of us to cut our expenses, but it also is a way for you to budget for saving, or what I like to call pay yourself first. It's kind of a strategy to look at your budget, and a budget can be really simple. In the photograph here, we see just a calculator and paper and a pen, and it can be that simple. Some people use, more online sources, but basically, all you really want to do in a budget is list out all sources of your income and categorize all of your expenses. So you're basically allocating funds for your essential needs, such as housing, utilities, transportation, and your groceries. And then looking at your other expenses that are elective expenses. There are some really great online tools that I like to use or suggest for budgeting. Some of them you can find at Mint or Good Budget. Honeydew is another one, DUE. And that's for budgeting with a partner, kind of handy sort of thing. Or another one that I like is called Fudget. And that doesn't require you to sync your bank accounts or anything like that. You could just enter numbers into a spreadsheet. So those are some really great tools, and I'd be happy to share those with you, in an email after the course here. So then, when you're budgeting for savings, the other thing that you can do really is identify areas that you can cut back. So when you're analyzing your expenses, start to identify areas where you might reduce your spending. One of my colleagues uses a great example that when she was younger, she used to purchase breakfast sandwich and a coffee pretty much every day. And it was probably, $4 to $6. And she calculated after 15 years what she had spent on breakfast sandwiches and coffee, and realized that she had spent about $35,000. So when you calculate it out over, just day to day, it doesn't seem much, but when you calculate it out over a long stretch of time, like 15 years, suddenly $35,000 in breakfast sandwiches can be a little shocking. So anyway, when you're analyzing your expenses, do consider where you can reduce spending. And the other piece is to look for discretionary expenses like dining out or entertainment, things like that. So I'm having a little technical issue here with my mouse. Hang on a second. There we go. Okay. Let's see, some other points I'd like to make, I suppose, are, finding creative ways to save on everyday expenses. Again, that might be cooking at home or carpooling. When I hang clothing out to dry. And certainly, just basic things like shutting off lights, to conserve electricity, reduces my electric bill and makes me much happier at the end of the month when I don't have a high electric bill. And then I suppose the other piece that I really try working with clients on is setting savings goals. As I said before, that idea of pay yourself first. If you can determine how much you want to save each month, or from each paycheck, that can really help you set a specific goal. And if you can even set a certain percentage of your income or a dollar amount aside, then you can really start to align your goals, your short, midterm, and long-term goals with your financial management. And then, by prioritizing savings, the pay yourself first model, you're really, setting things up so that you're prioritizing yourself and your savings and your future. And that, some of the tools that you can use for that, pay yourself first is, if you can come up with a percentage of every paycheck, you could even have automatic transfers go right into a savings account. And, you can also think of pay yourself first as treating your savings as if it's a regular expense, just like paying your bills. You're paying yourself first to ensure that your savings aren't an afterthought, but you're really prioritizing those. And it's a powerful tool, really, to help you control your finances and achieve your goals. So if anybody has any questions, feel free to jump in. If I'm moving too fast or giving too much information, because this is all familiar to me. But again, 2 years ago, this was all news to me. So I think, on this slide, it's really a little bit redundant to the previous one in some regards, but there are just some points that I'd like to really sort of underline, and that's like automatic transfers. If you can automate your savings setup, from your paycheck to your checking account and divide it into your savings account, if you can do that with your employer to have your paycheck get split, that's one strategy. Or checking, doing online, checking your balances on a regular basis and moving money around electronically can really help you, choose where your money's going. And consider a frequency that works for you. If it works to check it weekly or bi-weekly, or monthly, just stay ahead of those transfers so that you're making sure that you're reaching those goals. And again, you can select, a specific percentage. And, also, if there are direct deposit options with your employer, take advantage of those. If you can allocate a portion of your salary to go into a 401k or directly deposited into the savings account, just, that set it and forget it mindset can really help. And it really doesn't require a lot of effort on your part. If you've got, sort of your monthly expenses covered, then you know what you've got to play with. And then the other piece to look at with savings, is if you happen to get a windfall, if you do win that lottery ticket, even $100, or you get a bonus, at work, it's really kind of nice to tuck that away. And, often people, get a bonus and yay, it's a party right away. But if you could kind of restrain a little bit and think about it for your savings, that might be helpful. Tax refunds also, you can have those, think of a tax refund going right into your savings account. And that's a really great way to boost your savings. And then lastly, I think utilizing online apps and tools, there are a lot out there that can really help you automate your savings. Some of them offer roundup features that'll automatically save spare change from everyday purchases. Others can allow you to set up rules that trigger money to get moved from checking into savings based on specific criteria. And so those sort of tools, but basically the idea that I really want to stress is pay yourself first and save your money. You can really set that up for automatic transfers and really take advantage of payroll deductions and saving windfalls. And it's really the consistency over time, sort of that goal mindset, that you can really lead you to significant savings and progress moving forward. And that, when you make progress, it can really help you to get a sense that you're meeting your goals, and that can really help incentivize it for you. So I'd mentioned earlier about emergency funds, and emergency funds are a little bit different than a savings account. Ideally, you have both. And the point of an emergency fund is really that it's there with the expectation that you're going to bump into some emergency. And emergencies, can be any unforeseen event or expense that you are not anticipating. For example, it might be a car repair or a medical bill, job loss. I know we all lived through COVID and a lot of us got laid off, during that time, or, we couldn't go into work. And so if you had an emergency savings, you were probably in a little bit better position than other folks that had emergency experiences but no funds, or even the flooding we just recently had. It's helpful to have a little padding. So the primary purpose, again, of an emergency fund is really to offer that peace of mind. It's to ensure that you have funds available to handle those unexpected situations without sort of tilting your entire financial plan a little bit off balance there. And with emergency funds, it really, sort of the benchmark is 3 to 6 months worth of your regular living expenses are what should be in that emergency fund. So if you did have a job loss, you could bounce back. You'd have 3 to 6 months of wiggle room there. And one way to do that, of course, is figuring out your monthly expenses. Now that you've built a budget, you should know what your essential living expenses are, including your rent or mortgage payment, utilities, food, transportation, and any debts that you have to pay back. Oops, sorry, my mouse is misbehaving again, just bouncing around. Okay, let's see, building. I guess the other point that I'd really like to make is this doesn't happen overnight. And I think the word I used before was consistency. Building a fund gradually is really what it's all about. And, you can start by setting small goals, realistic savings goals based on your income and based on your expenses. You could break down the target amount into sort of manageable milestones. You know, in 3 months, I'll save X number of dollars, or in 6 months, I'll save so much. And if you work at that just over those shorter term goals, you know, by the time you get farther out, you may find that you're actually attaining the goals that you set, or you can rejigger if you need to. But, you know, consistency is key in contributing a portion of your income toward your emergency fund and your savings. And as your financial situation improves over time, you can always reevaluate and consider increasing contributions to your savings, or if you need to tap into it, it certainly will be there for you. And then lastly on this slide, I just really like to talk about the importance of separating your emergency fund from your daily accounts. If that emergency fund, if you really try to keep it, that 3 to 6 month amount in one account, and your checking and regular savings separate, it really can help you avoid unintentional spending, or, you know, sort of those opportunities that arise and you say, well, maybe I could. But if you open a dedicated savings account specifically for your emergency fund, that little separation can really help you ensure that those funds are there, that they're easily accessible in times of need, and really can help prevent temptation from dipping in. So let's see, what else did I want to talk about here? I think that's all I've got for you on that one. So speaking of emergency funds, so, you know, I'm not sure how many of you on this meeting were impacted by the flooding, but certainly that's something that's on a lot of people's minds, and a lot of clients that I've been working on one-on-one since July 10th have mostly been around, you know, rebuilding after flooding. And what I've basically been coaching my clients in is, you know, if they have flood insurance, if they have homeowners insurance, they place those claims first. You know, flood insurance is through the National Flood Insurance Protection Program, NFIP. If you were flooded and you do take FEMA disaster funds, then you will be required to carry flood insurance going forward, or you will not be covered in the event that you are flooded in the future. So it's just an important little piece to know. But you start with your homeowner's insurance, or renter's insurance if you're a renter, because renters also who had damage from flood can, you know, have their appliances replaced. I had clients who had washers and dryers in the basements of their rental house that were impacted, and they're, you know, they have to get that renter's insurance claim either rejected or approved before they go to FEMA. But then the next step is going to FEMA. FEMA may give you a settlement at first. It may not be enough, and they may suggest you go to the Small Business Administration, who offers low interest loans for disaster impacted folks. But you can always go back to FEMA and appeal their offer. Some other opportunities that are out there for homeowners, there's a USDA 504 home repair grant, and the USDA very generously adjusted that up to a $40,000 grant. Had only been a $10,000 grant for people 62 years and up. So they've really broadened that opportunity. There are also low interest loans available from VSECU and Opportunities Bank. Those are two of our funding partners that I often recommend folks to, because they do have often better rates than other larger banks. And because they're local, they sometimes offer a little bit more customer service, I think, than some of the larger online banks. But they specifically have low interest loans for folks that were flooded. And then, of course, the Vermont Community Action Partnership, that's Capstone Community Action, BROC, SEVCA, CVOEO, and Northeast Kingdom Community Action up in the Northeast Kingdom here. And then, of course, Efficiency Vermont is rolling out their opportunities. So moving on to financing rebuilding. If you were flooded, Efficiency Vermont has just announced rebates that are specifically for flood damage. And those are for homeowners, for renters, for landlords, for businesses, and those cover all sorts of things like appliances, heating systems, hot water heaters, and all sorts of things. Drive Electric is also offering some flood incentive changes for people whose vehicles were destroyed because of the flooding. So those are some opportunities. And I guess the other piece I want to suggest here is your utility company. They may also have some opportunities for you. And then just moving back to just general financial conversation here, establishing financial goals. It's the importance of setting financial goals are to set clear goals. Those clear goals can help you stay focused and motivated. They provide you direction and purpose, and can provide you a sense of achievement as you make progress. I think of them as like a roadmap, and they really can help you make financial decisions. The other piece is looking at your goals as short-term, mid-term, and long-term goals, really categorizing those and breaking them down, into some objective, discrete timeframes. The short-term goals might be, something you want to achieve within a year or less. Might be paying off a small debt or savings for a vacation. Medium-term goals, sort of, I think of as like that 1 to 5 year range. That might be a slightly larger goal, like saving to purchase a car. And then longer term goals are those sort of, broader picture, longer time frames that are, say 5 to 10 years or more. Those might be down payments for a home, retirement planning, or funding a child's education. And then, by prioritizing and reviewing your goals as you go along over time, you can sort of adjust them based on urgency or importance. Your personal values are another important factor in prioritizing your financial goals. And I think it's important to regularly assess those and reassess them to make sure that the goals are still relevant and they are aligning with your evolving financial picture. And that way you can adjust your goals as you need. And then I really also want to just really encourage people to really celebrate those milestones, along the way. It's not easy to manage money. It takes a lot of work to stay on top of it. So when you achieve those goals, really celebrate that. It helps you maintain your momentum and pat yourself on the back for achieving the goals that you set. And then one piece that I might have sort of swapped these, I guess, if in talking, but is something called SMART goals. And for those of you who have a kid in school, you may have heard your student's teacher talk about SMART goals. But basically, they're specific, measurable, achievable, realistic, and timely, or time-bound. I like time-bound. So specific is, what do you want to do? And you specify that. How will you know when you've reached it? How do you measure it? Is it in your power to accomplish it? Do you need help? And can you identify who you would ask for that help? Is it realistic? And again, if you need help in achieving it, who can you ask? And then the time-bound piece, when do you want to accomplish it? Those all can be really helpful ways of looking at your goals. And then strategies for saving on expenses or strategies for building savings, the best strategy to build savings is to cut your expenses. And cutting expenses can be easy, it could be difficult, but that first step again is creating a budget to track your expenses. Because once you've established a detailed budget, that outlines, your income and expenses, you could really track your spending over a few weeks or months to identify areas where you really may be overspending. And you could look at, are there places that you could cut back or find a cost-effective alternative? Are there programs or supports? For instance, for income eligible people, there's the Affordable Connectivity Program that reduces your cost for Wi-Fi and internet, broadband for your home. There may be student discounts available. Some other programs might be income qualifying programs for fuel assistance or discounts on your electric bill. Green Mountain Power does offer that for some lower income folks. So really, starting to check out some of those programs, that are out there. So, you could really look at those when you're creating a budget and tracking your expenses. And then another piece to look at when you're looking at your expenses and trying to find areas where you could save, is to really differentiate between your needs and your wants. Those are slightly different things, and I think you could distinguish between them because a need is essential. You need your housing, you need food, and so discretionary are the wants. That's the cup of coffee from the nice cafe down the street, or perhaps it's purchasing, something that maybe you don't need. And I'll leave it there because everybody has their own wants and needs. And I don't want to come off sounding like I'm discouraging you from enjoying your lifestyle, but lifestyle is different than living. So we'll leave that there. But basically prioritizing your spending on needs and then looking at your wants carefully. And then the other is, cutting back on everyday expenses. Those might be looking for opportunities that you could reduce your everyday expenses. And this is, the example I gave before of hanging clothes to dry. That's a really simple one that I use on a regular basis. It cuts my electric bill because I'm not using my electric dryer. But you can also, another way to cut back on your expenses, and I discovered this one a while back, but you can sometimes negotiate better rates for your credit cards, especially if you get an offer in the mail and the other credit card company is offering you a better rate or an introductory rate. You can call up your current credit card company and say, hey, this other credit card company is offering me an introductory rate. And I don't, I've been with you for a while and I really don't want to switch, but, can you help me out here? And sometimes they'll give you a better rate. And so it's worth a phone call to advocate for yourself and see. Another piece is, consider alternatives, like, packing your lunch can really save a fair amount of money. It sounds crazy, but I had used to get my lunches out, just even a salad, and it was pretty expensive. And I just stopped doing that and started bringing my own lunches, and that made a big difference for my budget. And then embrace living within your means. Once you have a budget and you can look at what your income is and what your expenses are, your necessary expenses, your living expenses, really trying to live within your means. And that might mean, embracing for a while frugal living. You can make a habit or conscious choices to save money. And that might be, I have a friend who is the coupon queen, and she it started just sort of at a necessity, and now she like will use these coupons that are doubled up, quadrupled. She shops for discounts and purchase things on sale, and she really is sort of the queen of the coupon and discount shopping, and saves a lot of money. And she's very generous and donates stuff to the food shelf as well, which is a boon for the food shelf, that she's willing to donate laundry detergent or diapers or other things that she gets. Other opportunities for savings and living within your means might be, secondhand items, or borrowing instead of buying. One community I know of in Vermont shares lawn equipment. So everybody doesn't own a lawnmower; they share one amongst a number of households, I think that's pretty cool. But yeah, so those are some opportunities. DIY, do it yourself. I did a lot of weatherization on my home by myself. I learned a lot, and it saved me a lot of money. And it still does, because I don't burn as much oil or firewood. I'm pretty happy about that. And that sort of speaks to my last, prioritize energy efficiency. So that, reducing your energy consumption, by lowering your utility bill, implementing energy saving habits like turning off lights when you're not in the room, programmable thermostats from Efficiency Vermont. If you're purchasing appliances, looking for those Energy Star appliances that are energy efficient ones. Those can all help save you money. Window dressers, window inserts help insulate windows, and those are done as community builds, and that's a great way to save energy efficiency, reduce your heating and cooling costs. So, by implementing some of these strategies, you could really effectively save money, and be able to put more of that towards your savings. So I'll just move on to types of savings accounts. So there's basic savings accounts, common, straightforward savings account at a bank. They typically offer a low minimum balance, requirement. It's, easy access to your funds. They often have a modest interest rate on the deposited funds. Then there are higher yielding savings accounts. Those are generally higher interest rates, but they might have a higher deposit or a minimum balance that you have to maintain. They might be, more ideal for folks looking to earn more money on their savings while still maintaining access to their funds. And some of those higher yield accounts have, read the terms and conditions carefully, I guess, is my rule of thumb there. Some of them might have, a limit to the number of withdrawals that you can make, or, a certain time, or the withdrawals are only allowed at certain times of month. Other types of online accounts are online savings accounts. And here's my mouse. My mouse is malfunctioning again, guys. Oh, drats. Let's see if I can get out of there. No, it's not letting me out. Oh, it all went away. That's not good. Hang on. Sorry, guys. A little malfunction junction going on here. There we go. Okay. I hope you guys are still with me. Michelle, are we still good? You're still seeing my screen? All right. Phew. That wasn't fun. Okay. So other accounts, let's see, where was I? Online savings accounts. There we were. Okay. So those online savings accounts are offered by banks. They generally operate only through digital platforms. They often have higher rates just because they're appealing to a much broader audience. As I said, they're competitive interest rates. There might be lower fees compared to traditional brick and mortar banks. And they provide, that online banking, it's mobile banking. And for some people, they really like that. For other people, they're not comfortable with that. But it can help you manage funds quickly if you have those online banking opportunities. Some other savings tools are called money market accounts. Money markets are sort of a hybrid between a checking and a savings account. And again, they offer higher interest rates than the basic savings account. You can also write checks or have a debit card. They typically have a higher minimum balance requirement. As I recall it, some of them were as high as, minimum balance of $10,000. So that's a pretty high threshold for a lot of folks to keep in a checking and savings account. There may be other better ways to do that. Another tool is a certificate of deposit, or a CD. It's a savings account. They come in fixed terms, or fixed time frames. So there might be a 9-month, an 18-month, a 12-month, and the interest rate is fixed, which, right now interest rates are high. So there's some really nice CD rates out there, returning around 4%. That's not a shabby return for a interest rate on an account, a savings account. If you do, the downside of a CD is if you do have to access those funds before that, the terms are up, before that time frame, there is a penalty for early withdrawal. So you lose some of your interest. But they're handy tools, and you can usually open those with minimum $5,000 deposit, some of them $1,000. So worth looking at. IRAs, or individual retirement accounts, are retirement savings accounts. Those offer a tax advantage, and there are two different types of IRAs. There's a traditional IRA and a Roth IRA, and each has its own tax implications. IRAs are designed to help individuals save for retirement. The contributions are tax deductible for certain ones. They grow tax-free for others. There's a new program that will be rolling out in the state, I think soon, called Vermont Save Program, but it has not appeared yet. But that's, I think, specifically for folks who work for small employers, under 50 people, small businesses. So examples of emergency of savings accounts, some examples, you have your emergency fund savings account, the IRA and the Roth IRA. There might be a 529 plan. If you're saving for your child's education, they don't necessarily have to use it for education. I think 529 plans can also be used for first-time home purchase and some other reasons, not only necessarily a college education. You'd also have a savings account set up attached to your mortgage, and what's called an escrow account for property taxes and insurance. That's kind of a handy way for banks and homeowners, mortgage holders, to have their property taxes held in an account until their taxes are due. Their property taxes are due to the town, and they pay the insurance as well. The bank pays the insurance as well. So that's a nice savings account. It's handy. It's sort of a set it, one and done. You set it and forget it. There may be holiday savings accounts that are, sort of special opportunities that banks offer for gift savings. And then if you don't have a credit history and you want to establish a credit history, there's something called a secured savings loan, where you deposit an amount of money with the bank, and then you deposit the same amount of money over time until you pay off the amount, and the bank will report you as having good credit, and that goes to the credit reporting agencies. So some other things to think about are maximizing your income. Looking at ways to increase income might be, exploring additional income streams, second job, taking side gigs, looking for opportunities to generate that additional income beyond your primary job. So that might be some, freelance work or part-time jobs, monetizing your skills and hobbies, selling things at farmers markets. There's also, sort of online platforms for gig economy, and those might show you some opportunities that align with your interests or areas of expertise. And then investing in your personal development. And by that, I mean, you're really working to take a class or professional development when it's offered at your job. And, workshops like this one, pursuing certifications, that all looks good on a resume and increases your value to your company because it helps you to develop new competencies. And it helps you stay up to date with industry trends. So, really staying competitive for the marketplace and building your job skills. And when you do that, you could also really negotiate a raise or a promotion, advocating for yourself in the workplace to, pursue a raise and a promotion. You can prepare a case highlighting your contributions to work, highlighting your training and the value that brings to the organization, and really do some research on industry standards and salary ranges so that when you walk into a meeting with a supervisor to negotiate for a raise, that you have a really good understanding not only of the work that you're doing and the skills that you're bringing, but also the value that you bring and what the industry standards compensate for those skills. And another really important part in building your income is really a skill called networking. Networking is just building your connections, building your professional network of people that know the quality of work that you bring. And, they may hear of an opportunity and let you know, or they'll offer a reference for you for a job, and just really tap into that because there are a lot of potential opportunities out there. Other opportunities might be attending, industry events or, association events, and just really sort of, putting a focus on what it is you're doing for a living, and really, sort of not just thinking of it as work per se, but that this is your opportunity, and it's your career, and it's your opportunity to build the life that you would like. Some other ways to maximize your income might be leveraging, entrepreneurship or a side business. So taking something that you were always interested in, or perhaps it's a skill that you have, and there's a market opportunity. And you might have a unique skill or something that you're passionate about that you can turn into a profitable venture. I've known folks that were enthusiastic about garlic and now own small garlic growing operations. Other people that were passionate about making pizza in a bread oven, wood-fired bread oven. And they now have a small side gig making pizza and love it. So you just never know. But conducting a little bit of research to develop a business plan. There's a micro business program through the community action agencies that can help you take steps towards that. But by doing those sorts of things, you can really maximize your income. And then I think the last piece, and we're a little bit over time here, and I appreciate you guys sticking with me. The last thing I'll talk about is investing for growth. I'm not an investment banker. I don't offer investment advice, but certainly understanding different investment opportunities are really a great thing to learn about. There's, as we saw interest going up in the last year, the cost of borrowing money has been going up. So in addition to that, inflation, the interest on bonds and CDs and savings accounts also pay a higher yield. So learning about those things are really helpful. And there's a lot of different opportunities out there. And investing does include risk. So if you are seeking investment goals, having financial objectives and timeframes, and really seek out somebody that can help you with that sort of thing. And I think I'll leave that there. But I'll just back up quickly and say, as you go along in your savings goals, tracking and adjusting your savings plan, regularly review your progress, celebrate those, milestones as you meet those goals, use budgeting apps and tools, and just make adjustments as you need to. And really, the last thing I'll say is that the Bureau of Consumer Financial Protection offers these free books, and I will make sure that Michelle Singer at Kellogg-Hubbard Library has some available, so you could stop in the library and pick up a packet of those. And I wish you the best of luck. I hope this was helpful. It was a lot of fun for me to put the slide deck together with my colleagues for you guys, and I hope that it was helpful.
Thank you, Laurie. I'm going to stop the recording and then we'll take questions from anybody we've got here.